Good afternoon, everybody. This is April over at Fairway Independent Mortgage, and this is my September market update. It is Wednesday, September 14th, so let's kind of give you the lowdown on the market, house appreciation, and where things are going for the remainder of the year. And share a good little PowerPoint. Once again, you guys, if any of you are interested in these PowerPoint slides, they can be great to use for clients, listing appointments, things like that. Please just reach out to me. You can call my cell, send me an email at april.ranallo@fairwaymc.com, and I'm happy to forward them out to you. So let's see where we are at today. The big conversation that I want to talk about before we get into the logistics of where we're kind of headed fourth quarter is discussing the Fed rate hike. The most common call I get from a lot of clients is, oh my gosh, April, we need to lock in that rate right away. The Fed's going to raise the rate again. I want to lock in before, the interest rates on the first mortgage get any higher. It is true. News are saying, Fed is supposed to raise the rate another 75 basis points next week. But what I want to let you know is that the Fed rate is different than what dictates our first mortgage rates. It is mortgage-backed securities that dictate our market, which in actuality, if you kind of follow the bond market, that is what will show you more of the ups and the downs that control my world. The Fed rate has more to do with home equity lines of credit, consumer loans, things like that. So important just in the general, financial education of our world, but they are not hand-in-hand linked, which is a good thing. In fact, the last time the Fed raised the rate, last month, our interest rates actually got better. It was a way for our market to see that, yes, inflation is happening. Yes, we may possibly go into a recession at the end of the year, the beginning of next year. But by the Fed raising the rates, they are trying to take control and help reduce the inflation going on, which made our markets feel more confident, and it actually decreased our rates. So we'll kind of see where things go next week. Lord knows, as I tell everybody, you may not see this, shake the 8-ball. Your guess is as good as mine. So let's get to what my side of the world is. Where are mortgage rates going? What does my 8-ball say that we're going to have? Here is a slide that is showing you where the rates have been just this year alone. Okay, the reason I like to bring this up is it looks like a roller coaster, and that's because it has been. If you can't tell, we all know they shot up right away at the beginning of the year, and then this third quarter that we've been having, it kind of going up and down, but they've been much smaller changes. So we have generally been anywhere from the high 5s to the low 6s for a typical 30-year fixed conventional loan. Right now, kind of still in that range. Like I said, depends on the time of the day and the day that it is. Where are the predictions of where they're going to go moving forward? The forecast for fourth quarter and then almost all of next year. They plan to kind of hang out in this range. We're probably talking, maybe they dip down a little bit. Like again, once they stay in the 5s more consistently. But don't plan on seeing any 4s or anything like that anytime soon. Here is something recently, a quote that I thought was great that said, after the end of the summer lull and as mortgage rates stabilize, we may see a return of buyers and relatively a strong fall housing market. I can tell you that I have seen this true on my side. All of my agents out there, hopefully you are seeing the same thing, where we kind of had a dip down in July and August, which tends to be typical, I feel like. People are busy with summer. People that got beat up over the spring market, couldn't handle the competition, decided to just take a break for a little bit. And then there's something magical when September 1st rolls around, kids go back to school, they decide to pick it back up, maybe give it one more little jaunt of trying to find a home before the holidays kick in. Because as we all know, typically around November, December, it slows down again due to people not wanting to sell. Have people go through their house during the holidays, or simply just once again take a break and decide to pick it back up the following spring. The next few months, we should be sitting pretty good. For those of you that have buyers that have been pre-approved, maybe you've been working with them for 3 months or a year, with the way the competition's been. I'd just like to make a valid note of kind of what they were experiencing, of what they were pre-approved for a year ago versus now. There is a difference. A year ago, the payment would have been about $1,265. Okay. Nowadays, at the same loan amount, with the increase in rate, it would be about $1,900. That is quite a big jump. That is a very nice car payment for a jump. So I can say that on my side, I've seen a lot of clients, they can still qualify for the higher mortgage payment, but it's just a matter about what is comfortable for their budget. And if you've had a pre-approval and it's been a few months or it's been 6 months, it's definitely important for your clients to have a conversation with their lender. I'd be happy to talk to them, just kind of refresh them of where things are at, give them a little bit of an update. I've seen most clients kind of going up a little bit to get to the price range they're looking at, but it's still important to have basically what I call a come to Jesus, just to kind of make sure everyone's in line and on the same page. So home appreciation. I know that you've all still heard that conversation out there of, are we going into a bubble? Is the market going to change? Oh, I'm just going to wait till next spring or next summer and when the deals are so much better. Most of us in the industry can agree that that is not going to occur, guys, unfortunately, for you clients. The supply and demand is still very strong and very steady. Construction obviously was occurring this year, but with supply chain cost increases, delays, the amount of new construction that was supposed to occur here in 2022 is not as high. And so we're still in a seller's market, which I personally think will be in for quite a few more years. Big thing that we're going to show over here, though, is what does that mean as far as appreciation? Should you buy? Should you rent, etc.? Here's another good quote of, I don't think national housing prices will decline in a meaningful way, but there will be some price declines along the country. This is why I feel like a lot of people are thinking, oh my gosh, we're going in a bubble, prices are coming down, people are slashing their listing prices. It is not as extreme as they are making it sound out there, or that it is. We have had some very, very, very strong appreciation over the last 6-9 months. You know, we have got appreciation was up to 11 to 15%, which we'll see here in a slide in a second. But with it being the end of the year, like I said, we had that kind of slowdown for July and September. Some listing prices or some prices are just getting reduced, and they're kind of coming back to a more normal level. So here's from January on. The red zone is the depreciation. This is when we would be having a declining market. That is not the case. There's huge appreciation over the last year, but what they're saying is that it's just going to go from that 15% range that's been back down to the 3.8 to 5 normal range of appreciation for year over year. So here, annual home price growth slowed for the 3rd consecutive month in July, which we've just discussed. Looking ahead, they expect a more balanced housing market with year over year appreciation slowing to 3.8% by this time next year. So once again, we're not declining, we're not depreciating, just the percentage or speed of appreciation month over month, year over year is going to be reduced down to more normal levels, which is good for the clients that are shopping. So here are a couple different things that the buyers can still do to try to win those deals. I do know that the competition is still strong. It's just instead of 30 offers, maybe you're competing against 3 offers, right? So for those individuals that had a certain budget, we discussed that big change in mortgage payments that occur. I've seen some, or what they can do is they can maybe expand the areas. Once again, to my dear agents, I know this is much more of a strong hurt, or I should say a pain point for you, is I need this house this exact way in this neighborhood, right? Doesn't give you a whole lot of options when there's not a ton of inventory. So see if they're willing to expand their criteria, maybe look at a few different suburbs, go a little bit further out. Other financing options. We're in the middle of the year. A big thing I discussed at the beginning of a new year is always self-employed people. How are they preparing their taxes or getting themselves situated? But for those that have filed the returns, the income the way it is, maybe we need to look at a bank statement program. Maybe we need to look at a cash flow program for any of the investors out there that are looking to buy some investment properties. Other than that, my superpower, round peg, square hole. So if I can figure out to make it work a regular way, I will come up with options to do that. And then lastly, cash. Cash is king, as we all know. And so a lot of clients may have the income that qualifies just fine to purchase the new property, but they're short on the cash for the down payment. There are a lot of down payment programs out there. Okay, there's statewide programs, citywide programs, county programs. Now, little side note, any of your clients that were planning on using a down payment program, do have them check with myself, the lender, the state, whatever, that the program is still available. because some have been eliminated throughout this year, but there is still plenty and plenty of options out there for them to get them in a house. So I thought this was a good point. It says housing is traditionally one of the first sectors to slow down as the economy shifts, but it is also the first to rebound. So those of us that felt a slower market all this year, yes, we're the ones that lead the charge, but we're also the first ones to kick it back into gear. So where are we at with home prices? This is a lovely little graph that goes all the way back to 2012. So we're talking over the last 10 years. Now, as we can tell, and everybody knows, the values of homes have drastically increased the last 2 years. But here's just a visual to show you how fast and how much they have shot up, and that they are the highest they've been in a decade. Here's your percentages of where they've changed just strictly in the last year. Okay, now, once again, if we were to go back, they all shot up straight up the last 2 years. And if you can't tell, it's been a consistent increase over the last year. But here's where they're kind of forecasted. So once again, not a depreciation, not a bubble, not all the housing market's going to crash. We are just slowing down the speed a little bit. So according to all the professionals here, everyone has their opinion, but the average we're looking at is for the remainder of the year for it to be probably around 11.3% growth for appreciation. Now, next year, they're forecasting that it will be lower next year, kind of a jump back down. But when you shoot that high up in 2 years, then it's going to just kind of come down next year, which will be great for everyone to kind of balance out the market a little bit. Where are we at with inventory? It is still a seller's market. As I said, I forecast it will be a seller's market for quite a few years due to the supply chain. But we are looking anywhere between 2 to 3 months of average inventory, and that has been consistent over the last year as well. This I thought was a little bit helpful or hopeful, maybe we could say. Here is the inventory where we've been. This dates back to 2014, so we're going back about 8 years. A lot more red zone in the last 8 years than blue zone. But if you look on the right-hand side, we got a little blue bar. That means that there is some hope. We might be getting some more inventory coming in the next year. This is just an idea to give you the new home inventory in relation to 21 versus 22. Let's see here. The dark blue bars are last year, obviously with the full history, with 22 being the light blue bars. Now, this is, once again, I just like this graph to show to everybody that explains the inventory is improving. Okay, this is how we're able to maybe have the competition be a little bit more of a normal level versus the wild, wild west that we had in the spring. We'll have to see how the rest of the year kind of pans out, but a little hope along the horizon. And that is your basic update, market update for September of 2022. So thanks for listening. Hopefully you got a couple of little good tidbits, and I will once again do this every Wednesday, second Wednesday of the month. So stay tuned for next month. Happy back to school, everybody. Enjoy the rest of your day. Thank you.